Hi guys, my name is HTrade and I am a partner trader of Wesley Trades. Now basically, if you want to join the Wesley Trades HQ free Discord community, all you have to do is have a look at the description of the video that I'm creating now. Or you can actually go to YouTube. You can simply search for Wesley. Let's search for Wesley Trades. Boom. Search for Wesley Trades, right? And what do you get? Wesley Trades himself. Go to Wesley Trades channel, and then you can click on this link to go to the absolutely free Discord community where there are a lot of like-minded traders out there that would like to make a lot of money in trading, but also learn together as a whole. All right, so let's go to the Discord. So here we are at Wesley Trades HQ. I am one of the partner traders, as you can see, and today I would like to show you just a few things here on the Discord before we get to the strategy. Now, first of all, the strategy that I'm about to show you, I can clearly show you my results here during April so far. Started making a deposit of $106, making steady withdrawals on a weekly basis. And yes, sometimes I make a mistake. As you can see in trading, I mean, nothing always goes according to plan. Made an extra deposit in that account, and then I also made another withdrawal on the 21st of April. So far, it's been steady. And I also have a journal in the Wesley Trades HQ. Using the journal is completely free of charge. You can actually go to the trading journal, click here. You'll see there's a lot of other members that also have trading journals in here. And they document their journey as they go. Like I said, Wesley Trades HQ is completely free of charge. You can have a journal here. There is channels here that you can use to communicate with a lot of like-minded traders out there inside the community, and we just help each other and we have fun. So on a regular basis weekly, we have live trading sessions as well. So once you join, you can actually just keep an eye on the announcements, because in the announcements we tell you guys we're going live, etc. We're going live in the Wesley Streams section. The Wesley Streams section is under the Wesley Network. You'll see the Wesley Streams section here, and once we are live, there will be a big pop-up window here in the Discord once you are in the Discord, and then you can click on the join button. It will pop up here at the top left somewhere. All right. Also, one last thing I want to mention is that Wesley Trades HQ have been partnering up with PU Prime. Now, PU Prime is a very cool broker which provides free education for traders out there and a lot of other free extra stuff. So when you join the broker, actually you can just follow these steps here. On the left hand side, there's a section in the Wesley Trades menu where you can read the steps from 1, 2, 3, 4. There's also a recorded video walkthrough that Wes has recorded to get started. All right, so that's really cool. In any case, I would just like to get back to the purpose of this video. I would like to show you my strategy that I've been using to get constant withdrawals so far this month. So let's get started. All right, so let's immediately go to the charts. All right, cool. So now you can see there's an indicator where I show my, just a reminder to keep track with my strategy, right? So you don't necessarily need something like this. I can actually just remove it for the time being. Let's make it as clean as possible. Right. So what do we do next? So first thing, let's go to the 1 hour chart, since we will be using that for the higher time frame bias, right? So let's just get here. Cool. Now you can see there's our 1 hour time frame, and this is how it looks currently. So I would actually like to make a replay, right? So let's start Yeah, let's start off with by going to Monday. So before I do anything, right, I would like to show you my strategy. Just going to write it out, right? Very simply, what is the first thing that we are going to have a look at, right? So let me write it out for you. Boom. First of all, we're going to have a look at how are we going to determine what is our higher time frame direction, right? So that's the first thing that we're going to have a look at. Okay. Second, we're going to have a look at, before we go into a trade, what are we looking for first? What would be our signal in brackets? I'm going to put it in brackets, right? What is going to be our signal before we even look for a trade? So first of all, we're going to look for a higher time frame liquidity sweep. And what are we looking for there? Right? So I'm putting it here for you. I'm going to use a 1 hour turning point wicks. I'll show you how that looks like, and especially regarding the fair value gaps as well, right? And of course, what is the last thing that you do? You simply enter the trade. So what are we looking for in our entry model? And also what that is going to look at regarding the risk reward management. Right, so first thing in our entry model, what are we looking for? Right, we're looking for a market structure shift. And then after that, what are we looking for? A retracement into what exactly? So number one, we're going to look into retracement into the 45 or 50% Fibonacci on the Fibonacci tool. I'm going to show you guys how to use the Fib tool properly as well, right? And or a retracement into a fair value gap, right? So that's fine. And then the last thing in our entry model that we must see before we enter the trade is a candle printed in the direction of the TP target. Let's do this. In the direction of the TP target. Beautiful. So this is what we are looking for, right? So let's show you how you can determine. Let's go to step one, basically, right? So how are we going to look for the higher time frame direction? So what are we going to look at? All right, so the higher time frame direction, right? We're going to look simply at the highs and the lows of the candles. It is as easy as that. So what do I mean by that? Right? Let's go further down. Obviously, you can clearly see that this is a bullish direction. Because why? We are making what? We are making lower low, higher high, higher low, higher high, higher low, higher high. This is an absolute clear bullish setup, right? So I would just like to show you how does it look for a bearish direction. And this is a very short one, but it's very, very easy to look at if you use your eyes here, right? So higher high, lower low, lower high, lower low. This is still a lower high and lower low. This is a bearish direction, right? Right. Cool. Next, so how are we going to determine our bias when we look at the direction? How are we going to use that? What tools are we going to make use of to determine our higher time frame direction? right? So I like to use, I simply like to use to trace the candle bodies of the 1 hour time frame. So I simply do this. I take a trend line tool, draw a line like this, and then I see, all right, cool. So now we have broken above that line, and now we got to retrace. So basically I draw a line here. Since we've broken that high, now I can say, all right, cool. So now we're looking at this as the new low. And now we look at this as the new high. So now we just follow the price. As you can see now we have broken this high. So what is the new low that we are going to look at, right? So now we can actually use this as the new low. Very simply, because this high has been broken, price has shot up into the sky. Now we can actually use this as the new low, right? So like I mentioned, if we are in an uptrend, the price is going to make higher highs, higher lows, higher highs, higher lows, higher highs, etc., etc., right? So what do I also use when I look at my higher time frame bias? I'm going to make use of the Fibonacci retracement tool. I use this tool if I want to look at where is the retracements possibly going to go into before it might possibly make a retracement and go back further into the higher time frame direction. I'm going to make use of the Fibonacci tool, Fibonacci retracement tool. So if you're looking at an uptrend, you're going to draw the Fibonacci tool from the low to the high. Boom, there we go. Let's do this. And these are the levels that I personally use, right? On the Fibonacci tool. I use the 45% level, I use the 50% level, I use the 61.8% level, I use the 75, and I use the 80% level. And obviously the low, the 0 and the 100. All right. So basically, from the low to the high, wait for a retracement, and then look for a buy during this move going up. All right. So that is literally the short and sweet of it. So you can use many examples. Many examples. Now, since we have been in a very strong bullish move, obviously you can use your Fibonacci tool from the low to the high. Then from that low to this high. And then from this low to this high, etc., etc. You can keep on following, keep on using your Fibonacci tool like this. This is a small retracement. I would say this is a small retracement. Why? Take a look at this. So here, the low has been broken. Suddenly, the high has been broken, right? So what do you use now? You use the Fibonacci from the low to this high, wait for a retracement and going up. So during this retracement going up, it's very difficult to get a buy because price did not really retrace back to the 45% or the 50% level. But all we have to know is what? Price went down, price went up, price went down, breaking this low, price went up, breaking this high, small retracement, and boom, shot into the sky. This is how a market structure shift looks on the higher time frame. Right? We went up. What did we do? We traced all the way back down to a specific level. So if we want to just keep an eye on the retracement, what do? So what was the low before this high was broken? This one, yeah, right? So now we still take the Fibonacci tool from this low to that high, to this high, right? Where did we retrace? My question to you is, where did we retrace into before price started going back up again? Very easy answer, 45% or the 50% retracement level. You can look at this level retracement, this level retracement, this level retracement, this level retracement, but here we can dangerously see that if price starts to go into this direction, here, this is a very dangerous retracement level. Why? Because now price is not using a continuation buy. It's actually starting to possibly go into the other direction and make break this low possibly. And then we're going to start looking at sells instead of buys. So yeah, continuation buys normally go to 45%, 50%, 61.8, and 75% at best before it starts going into the other direction again. And also, let me ask you this. So what did price do after it broke this high now? Right? There we clearly see price closed above that high. So what do we do now? Now we can actually use our Fibonacci tool and use this as the new low. Draw the Fibonacci tool to this new high. Right, there we go. I'm just going to stop it here. There we go. Price started retracing into what? 45, 50, 61.8. Boom. Started shooting back up again. All right. Now we have broken this high. Now we just keep on adjusting our Fib tool. That's going to be the new low. That's going to be the new high. There. And eventually, price did make a retracement here, but not as big as 45 or 50 or 61.8. But what did I mention to you earlier? What do we need to keep in mind? That we are making what? Let me show you. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. This just shot up into the sky, right? So you can clearly see we are still in a bullish momentum. This is a bullish direction. Now, I'm not going to show you how the bearish direction looks because at the end of the day, yeah, let's have a look. Let's do this. How does the bearish direction look? Simply higher high. Whoops, let's just do this. Let's just delete that quickly. Whoops. Let's just delete that. So basically, price it up. Higher low, higher high, higher low, higher high. Suddenly, lower low, lower high, lower low, lower high, lower low, lower high. This is still a lower high. We haven't broken or closed above that one. Lower low. This is still not really a new lower low either as well. This is all internal structure. This is the actual proper new lower high and lower low. Internal structure, we just keep on following, and then here it started breaking this low now. This is a proper bearish structure here. You can clearly see that, right? So, and we do the same thing with the Fibonacci tool. We just keep on. Now you need to draw the Fibonacci tool from this higher high to this lower low. And then here, price got broken. There we go. Right. So what do we do now? We still keep that Fibonacci tool here. That's the new lower low. We started retracing, but not further into the 45% level. But we broke this low. Now this is going to be, what was the high before the low got broken? Still, that was the one, right? So price went up and we broke this low again. All right, so now we're going to draw another line here, for instance, or here, doesn't matter, right? Now we're going to adjust our fib tool. We're going to keep on adjusting it. So this was the high before the low got broken. We had a retracement up into the 75, 80%. We're dangerous, and started going down again. Right, when we went down and we broke this low, what was the high? This was the high, but price started retracing into this high here and then started going back down again. But we still need to keep in mind, what was the low? What was the high before this low got broken? That was the actual high before the low got broken. So you can still draw your fib here. You can actually draw the fib tool down here to that specific low. And then you can see what was the actual retracement. 61.8%. 50% before we started going back down again. So what is our new high here before that low was broken? This one, right? So you can go down, you can go down, you can go down, etc., etc., etc. That was actually still a proper low. This was still a proper retracement. We got that low that was broken here. And then when this high got broken, then price started going up. And that is where we start going into a buy direction again. Right. So this was just to show you guys how a bullish direction looks on the higher time frame and how does the bearish direction looks on the higher time frame. And at the end of the day, when we take a trade, we always target internal liquidity to external. Internal to external. What is the external liquidity at the end of the day? So it's basically the last best low or high that was created. So when we go into a bearish direction, then this is your external liquidity. This is your external liquidity. That would be your target for a sell, right? This is your external liquidity. So when you sell to this level. And you go on and on and on. So this is your external liquidity. Until the direction changes, now this is now going to be your new external liquidity for your DP targets. Retracement. Get a retracement here, right? So what is your new external liquidity target? This. Or a buy, right? Retracement. What is your external liquidity? This. This was the new best high that was created. Boom. That's your target. Right? And so forth and so forth. So what is your external liquidity? This. External liquidity? This. The newest high that was created. Buy into external liquidity. Buy into external liquidity. And so forth. Price went on. Here we made some form of retracement. Right? Retraced into this level here. So what is your external liquidity? This. Price started going up. Boom. So this is just a very quick explanation on external liquidity because internal liquidity is simply fair value gaps. But I'm going to show you now what is proper internal liquidity as well. Right, so internal liquidity is very simply just two things. Or high time frame liquidity, right? So this is actually part of the higher time frame liquidity and the liquidity sweep that we're going to look at before we go into any trade, right? So internal liquidity, or liquidity, the liquidity that we're going to use for a sweep is simply the 1 hour turning points or 1 hour fair value gaps. Now, what is a 1 hour turning point? Right, so let's just delete everything that we've currently did so far. Right, so very simply, external liquidity, internal liquidity is simply these wicks, these wicks. Price swept those 1 hour wicks. We tapped into a 1 hour fair value gap, which is a 1, 2, 3 candle movement with a gap in between the second candle of the wicks of the first and the third candle, right? So this is a fair value gap. I normally turn on a indicator to show me the fair value gaps because sometimes you can't see it with your eyes, right? Easily. So this green candle shows there's a fair value gap in between here. This red candle shows me there's a fair value gap sitting here, right? So this liquidity gets tapped. We're looking for a buy. We're looking for a retracement. And now we got the buy, right? And what is your external liquidity target? As I explained before, the latest highs that was created. Like this high, we can clearly see price went to reach this high. So if you would have gotten a buy somewhere here, no matter what your stop loss is, I'll show you now in a moment what is your proper stop loss that you can make use of. So what is your target? There's your target. All right. What is your internal liquidity? What is your external liquidity? Your external liquidity was in this case, since we're looking for a buy, this is your external liquidity target. So what's your internal liquidity? Internal liquidity is 1 hour turning points, the wicks on the 1 hour turning points. So we can clearly see have been swept here. And also what else? Fair value gaps. There we go. There's another fair value gap. Tapped into that fair value gap, price started going up. We tapped again into that fair value gap. Second time, third time, price started going up. Also, what other internal liquidity was taken? This. 1 hour wicks. Tap into this liquidity. Boom, there we go. And made a retracement. So what other liquidity did price tap before started going up? 1 hour fair value gap. There we go. Also, we have a turning point here on the 1 hour time frame. Bearish candle, bullish candle, right? Turning point. This whole candle wick, those two turning candle wicks are liquidity. Internal liquidity. Tapped into that liquidity, price started going up. Price make a new high, right? This is a simple example here. Tapped into the internal liquidity, which is a fair value gap. Not only that, but we took that, you see that? That's also a turning point here, right? So let's do this, right? Okay, candle up, candle down, candle up. You see? Turning point. Candle up, candle down, candle up. Turning point. After tapping into this 1 hour fair value gap, price started going up. And what is our target? very easily the latest high. Boom, that's our target. And so on, and so on, and so on. Yeah, we can draw a Fibonacci tool. That is a low, that is a high. Price started retracing into the 50%, 45% level, as well as what? Internal liquidity. Those are the fair value gaps. Price tapped into that. And boom, external liquidity target reached. That is our target for our buy. Boom, there we go. And so forth, right? And so on, and so on, and so on, right? So take a look here, right? So if this is our liquidity target there, right? This is our low, this is our high. So let's do this. Price still took more internal liquidity here before it started going up here again, right? So yeah, let's just quickly disable this fair value gap indicator, because as you can see now, we can't see the turning point that was taken before this actual move went up. So yes, we tapped into a Fibonacci retracement here, 50%, 45%, 61.8. Price started going up. But if you wanted an extra entry into this buy, you simply wait for a turning point liquidity that can be taken. So very simply, price went down, price went up. There's your your internal liquidity that has been taken. We tapped into that. We even broke that low, and price started going up. This is still internal liquidity. It may look like external liquidity, 100%, but it's also internal liquidity. What internal liquidity? We are inside a movement going up. Yeah, your bias says look for buys, right? So this range. This is actually called a Fibonacci range, right? So from this low to this high, this all here is internal liquidity in this move going up. Price took that internal liquidity, started going up. So this is a 1 hour turning point. Right? Boom. Price started going up. What's your target for this buy? Simply this external liquidity. You can use the wick. You can use the body of this 1 hour candle as the external target. You can use this as the proper external target, etc., etc. Right, so I've gone very deep into this, explaining it very good, because I want you guys to get what is actual proper higher time frame liquidity that you can make use of to be swept before you go into a trade. It's very, very important that you get this, because let me show you this as well. So you may look at this as another buy, right? What internal liquidity was taken here, right? Price started going up, price started going down. This is still internal liquidity, because in this move up, this liquidity can be taken for this buy going up. See, this is still part of internal liquidity. If your bias is bullish, then this is internal liquidity that can be swept for a buy. All right, cool. I've gone, like I said, I've gone into this in so much detail as I possibly can. There's a lot of examples that you can make use of on the charts. You can go and look for them. I'm going to show you more examples as I show you the entry model, because we're going to break down a few trades when we go, when we do the breakdowns. So yeah, all right, cool. So this is higher time frame liquidity, or higher time frame liquidity sweeps, right? So now we've broken down step 1, higher time frame direction, right? How you can determine the higher time frame direction. And now we've broken down step 2, high time frame liquidity sweep, 1 hour turning point wicks, and fair value gaps. All right, so now we move on to step 3, which is the entry model and the risk reward management. So risk reward management, I'm going to use it as a step 4, but it's also still included into the entry model itself, because you're going to, once you use the entry model, you need to decide immediately where is your risk and where's your reward going, targets going to be. So yeah, all right, so let's move on to the entry model. All right, so now we're getting to the good part, which is the entry model, because now we're actually going to start breaking down some trades. All right, cool. So first of all, we have been doing everything on the 1 hour time frame, right? Which is the higher time frame confluences that we work with for direction and liquidity sweeps, right? Step 1 and step 2. Now we're going to go down to the 5 minute and the 3 minute. Right, so the 5 minute we're going to use during London session, because I'm going to focus my trades on London session, or breaking down the trades during London session and New York session, right? Okay, cool. So for this, I'm going to, let's see how we can make this a little bit smaller. Just keep in mind, when it comes to higher time frame direction, internal to external liquidity targets only, right? Cool. Then high time frame liquidity sweep first, either taking down or breaking turning point wicks, or tapping turning point wicks areas there, or tapping a fair value gap, right? That's the liquidity that we're looking at. So let me just quickly, let me anchor this, right? Not lock, anchor. So that when we move this chart, it will stay here on the right hand side. All right, perfect. So now we have to remove quite a number of things here to get started, because we want a clean chart, right? Delete everything here that we've worked with. All right. Cool. We don't need anything further than this. All we need to know is that we are in an uptrend. Very, very easy uptrend. Right. And now I'm going to keep the 1 hour on the right hand side while we work with a lower time frame here on the left hand side. So now I'm going to go to the 5 minute time frame. All right, and I'm going to turn on my session indicator. So this is the first thing that we're going to look at when we take a look at the entry model. A lot of ICT traders make use of session highs, session lows, daily opening price, weekly open price, daily high, daily lows, weekly highs, weekly lows, etc., etc. You name it. There's like a ton of liquidity points that ICT traders make use of. I am not fussy when it comes to liquidity. I always just look at 1 hour turning points, 1 hour fair value gaps, etc., etc. And then I make use of the Fibonacci tool. All right, so what did we discuss? So we are currently in a bullish trend, right? So what is the closest Fibonacci retracement that we've made use of? I think it was this one here. And then price reacted, broke that high. That's the high. That's the new low. Higher low, higher high. Cool. That's our starting point at least, right? Cool. So now we know that we can expect a possible retracement back down to this level before we would like to look for a buy, since our higher time frame direction bias is currently bullish. So we have step number 1. Step number 2 will come as price moves, right? So now let's just quickly delete this, and we can just keep the Fibonacci tool on the right hand side on the higher time frame. And we can turn on our session indicator, because we are going to make use of sessions, session highs and lows, etc., etc. Right? Okay, cool. So this was the previous New York session on Friday, 17th of April. So let's move forward. Cool. Now let's go to Monday, right? Oops, let's do this. Okay, ooh, we open up with a very big gap here. And I love gaps, because usually the weekly gaps especially, they like to be filled most of the time, like 70-80% of the times when a weekly open gap gets created, it loves to be filled. And wouldn't you know that we opened up inside what area? The area that I told you guys what exactly? That there's a possibility that price might go to retrace before it might continue its move up. Right? So now we're on Monday. And since we've already tapped quite a lot of liquidity, internal liquidity, which is what exactly, right? Which is fair value gaps. Let's turn on the fair value gap indicator. There we go. There's like 1, 2 fair value gaps here. I'm going to just do this. So cool, liquidity tapped. So now we have our high time frame sweep, right? So step number 1 is direction. We got our direction. Step number 2, liquidity sweep. We got our liquidity sweep, but we are in the Asian session. So I'm not going to bother with taking any trades in the Asian session. I don't trade during the Asian session. I just wait for the London session. Cool. Let's move forward. Let's move. I'm going to just click on the play button and pause. When I see London session is going to open, okay, here on 3 a.m. EST. So now we wait. Now, before we go to the London session, let's just keep track of more liquidity that was taken. Here you can clearly see we have already tapped more internal liquidity, which is this turning point right there. We tapped it. We took that low already. Beautiful. There's your liquidity sweep. Beautiful, right? So what now? Now we wait for our entry model, which is what? Market structure shift. So what is a market structure shift? Very simply, on the lower time frame, it is a move where, let's say this is the high, this is a low, lower high, lower low, lower high, lower low. Suddenly, price turn around and break. Instead of making a lower high, we make a higher high. That is a market structure shift. So it's breaking the current market structure. So that's number 1, market structure shift. Now what's next? Retracement into 45 or 50% fib on the Fibonacci tool, or a tap of a fair value gap on that lower time frame, 5 minute. And then lastly, we wait for a candle to be printed in the direction of your take profit or your profit level, right? So let's do something like this. And then you target this high or the previous high or the previous high, like this high, for instance. This is one of the highs that can be targeted. Or obviously the high of this gap here. In any case, doesn't matter, but you get the picture, right? So, and then for a buy, and then for a sell is exactly the opposite directions, obviously. Okay, let's just finish this. Okay, low broken, high broken, retest 50 or 61.8%, and then print a bullish candle in the direction of your TP target, and then enter your, let's say this is your entry. You can take your stop loss at the 80% level of the fib or the 100% level, which is the absolute low, and target 1.5 or 2. Boom, there we go. That is what our target's going to be for most of the trades that we're going to take, right? Or you can be brave and target the whole fair value gap where it started. Right, cool. So that is a buy entry model. This is a sell entry model. So low, high, higher low, higher high, higher low, higher high, we break that higher low. So instead of it making a higher low, it makes a lower low, lower high, and sell off. Like I said, structure shift right there. Retracement into what? 45 to 50% of the fib tool, or a fair value gap of some sort, and then print a candle in the direction of the TP target, right? So let's just, here's our fib. And then we take our sell tool. Once the sell candle is printed, stop loss at 80% or 100%, and aim for 1.5 or 2. That's it. You guys can pause this video, have a look at this, study it, etc., etc. I'm going to move on so that I can break down the trades for you. All right. So let's move forward. All right. So let's just quickly delete this. Cool. So now let's move forward. Okay, there is our immediate entry. Well, not our entry, our London session. So what did we do? High, lower low, lower high, lower low, lower high, lower low, higher high. What are we waiting for? A small retracement into 45 or 50% fib tool, fair value gap, you name it, and then a candle in the direction of the TP target, and entry is made. Right, cool. So let's just keep track of it by doing this. There we go. There's the market structure shift because that low was broken. This liquidity was tapped. We broke that high, waiting for a retracement of some sort. It can be either 50% of this or 50% of this is also fine. Let's just quickly see what's going to happen, right? Move forward. Boom, there we go. Right, what are we waiting for now? A bullish candle, since we want to buy. Boom. Entry made. So this here is exactly entry made. Sorry, I wanted to stop it. I didn't know if there was a... I didn't know what's going to happen next. I put my stop loss there. Take profit, 1.5 to 2, risk to reward. Let's just do this. Or nearest high, up to you. Let's take a look here on a 1 hour time frame as well. Right, let's just keep this here on the right hand side. Just keep an eye on it. Okay, let's move forward. Yo, we nearly got stopped out there. Very nearly. We're still in the trade. And as you can see, you could have taken your partial exit here. There we go. Or you could have waited for another entry. Right, so this was our first market structure break, which means that price can still come down. And if you want to catch a continuation trade, you could enter here, 45%, 50. Then you just wait for your next bull candle. There we go, entry. Could have taken your entry there as well. So that's if you've missed the initial trade. Wait for a retracement. Could have entered there. Now your stop loss is not going to make sense if you take it here, but maybe you can just take it to the 50 to the 80% level of the fib tool, and then you can aim for 1 to 1.5 or 2 risk to reward. That purple line is the fair value gap, the weekly gap that was created. So Let's keep an eye on it. Beautiful. Take profit hit. That was an absolutely beautiful breakdown, even if I do say so myself. This is a really, really good example of what I'm teaching you in the strategy. Absolutely beautiful. Now, there are some people that likes targeting session highs and session lows of previous days. It's their prerogative. They can do what they want. In my case, you can aim for 1.5 or 2 risk to reward. Up to you. So now let's take a look. Where are we on the 1 hour time frame? We are actually very close to this high. There we go. All right, but that's literally your trade for the day, guys. Now we're getting to New York session. What now? Let's see. So let's see if we can get something in the New York session. All right. Just keep in mind, we've already filled this gap. So there's a possibility that we might get a retracement. But what are we? Bullish. Currently bullish. So I do not want to sell right now. I don't. What am I doing? Let's go back. Cancel. All right, there we go. Bit better. Where are we now? Friday the 24th. Okay, why did I exit? In any case, let's go back. Let's go back. Let's go back. Let's go back. That was a little bit of a mistake, but it's fine. It's not the end of the world. We are here right now. So let's get back here. Obviously, we can now see that there was a retracement back down, which is fine. But what? We are bullish. New York session, we took the high of that fair value gap. We got a retracement or sell. Now, during New York session, I like to go to the 3-minute time frame because of the volatility. So I trade 3-minute time frame during New York and 5-minute time frame during London. Right. So yeah, if your bias is to look for a sell right now, what do you want to see? You want to see a low. You want to see a market structure shift first. So price went up, higher low, higher high, higher low, higher high, higher low, higher high. We broke that low. There's our market structure shift. There's our retracement. You could sell like this once a new bearish candle has been printed. So there's the high that has been broken from right there. So where's the low? If that's the high that has been broken, where's the low? Right there. Let's just zoom in for a bit. Right now it makes more sense, right? That's the low. Broken. There's your market structure shift. Retracement. And now you look for a sell candle. Let's wait. There's a sell candle. Boom. That's if you want to look for a sell. Remember, okay, I always like to keep my options open, but when it comes to higher time frame bias, I always stick with higher time frame bias. But like I said, there's a lot of other traders out there. I mean, the market is open for everybody. They can trade whatever they want, whatever direction they want. So if they're prerogative to sell, because we are at somewhat of a high after filling that gap to get a possible retracement, that's perfectly fine. They can do what they want. They could have gotten their take profit as well. See? It's not a reversing, but they could have eventually got their take profit in any case. Just like that. Boom, there we go. Even further. All right, right? You get buyers in the market, you get sellers in the market. You get your own personal bias that you choose. And remember, when you choose a bias, you stick with that bias until the bias changes, and then you change your direction as the bias change overall, right? So if I were to buy, if my higher time frame bias says I need to buy, I wait for what? Liquidity sweep of what? A fair value gap or a turning point. There's a turning point. Let's just quickly delete that and that and that cell. Right. So what here? Candle up, candle down, candle up. There's our liquidity. And here is even more liquidity. You can actually extend it to this. Let's do this. You see now you can see that the candle wick on the 1 hour time frame, right? So this is part of the liquidity. There's your 1 hour liquidity. We're tapping into it at the moment. Remember, 1 hour liquidity is created every single hour. Like the moment that this candle closed, there's that liquidity there that can be used immediately. All right, let's just keep an eye on it here on the left hand side. What I also want to keep an eye on is the overall Fib2 on the higher time frame. There we go. Right, just keep that in mind as well. Let's wait for it. And we still kept on going down. The market can do what it wants, even if we like it or not. Right, cool. So, more internal liquidity taken. We're at the 50% or 50% market structure level, liquidity level. Now we're waiting for a high to be broken. The problem is that we are done trading. It's already 11 a.m. EST, so it's now out of the macro time frame. So unfortunately, I like to stop trading at 11 a.m. EST or UTC -4 at this point in time. So I don't really want to look for trades anything further than this, but you can keep in mind that we are what? Tapping 1 hour liquidity. You see there's more internal liquidity here. We are tapping that liquidity. There we go. See? Just like that. Now we wait for a high to be broken. This is not a proper high, to be honest with you. That's just a turning point. Normal turning point. If you want to use that as a high, then you can start drawing your Fib tool here to see where your retracement is going to come from. There's somewhat of a retracement. And okay, tapping the 45% level. Wait for a bull candle, which we got, and you can enter here. But we're already outside of the macro. That's the problem. And aim for 1 to 1.5, something like that. And as you can see, because we're outside of the macro, the volatility is also down. That's why people don't like trading outside of the macro. But you can clearly see we had a reaction once we have taken that 1 hour low. Liquidity sweep. Right. Okay, cool. So I think for Monday, this is absolutely more than enough. We've broken down a beautiful buy trade, a sell retracement trade as well. So if you were a seller, to look for a sell after that gap has been filled, that weekly gap has been filled, and another buy trade during the New York session. If you are still buyers on your highs, if your buyers are still bullish on your higher time frame direction. So now we can actually move on to the other days. And actually, like I explained, the risk reward is inside your entry model. So you need to make sure that when you take an entry, that you make sure that your risk reward is proper. Like when you risk an amount and you put your stop loss here, for instance, and then suddenly after you are already inside the trade and then you decide to extend your stop loss, then you need to know that you are over risking yourself as well, overextending your risk. But so that's why it's very important to make sure that you place your stop loss at a decent level, like the nearest low now in this case, previous low, and take profit at an appropriate high level or the most recent high. We are outside of the macro, like I have explained. Boom. Okay, take profit it. Beautiful. But we're still outside of macro, so okay, I think we can actually stop here. So this is 1 day, right? So I've explained to you the entry model, I've explained to you the higher time frame directional bias, the liquidity sweep that's needed, and the entry model that you can make use of. So I think this is more than enough for the first video. I think on my second video, I'm going to make a part 2 to break down this whole week's trading moves that have happened, so we can get some experience, some what do you call it? Some forward testing or some back testing in with this method. So yeah, let's see. All right. Thank you so much for watching, and I hope you enjoyed it. And I hope you can actually test it over and over and over again, because it's going to help to get more practice in at the end of the day. All right. Thank you so much. Cheers.